Aloha, this is Joshua Hayes at BigWaveTrading.com for your September 12th update. Well, it was a very interesting day today because I noticed that some banking stocks got torn apart, like Washington Mutual, Lehman Brothers, and I saw Merrill Lynch actually went below the lows of the, I can't quite remember, but I know it was in at least July that I think that it happened in, where it had its huge volume day with a nice price bar. Bop went max green, and I think it's actually crashed below it by it over here. Okay, I can pull up over here. What am I thinking? Oh wow, 12% today, and in 3 days 31% crash underneath what looked to be a real low, and the chance of that low holding, let me just bring it up here since we're talking about it overall. This bar right here is Merrill Lynch, and the fact that this did not hold, because that is a ton of buying right there with the open candle bar near the top. For it not to hold means that those investors dumped and got out, and as you can see on a 2-day volume, it's actually much heavier than the accumulation day. So whoever supported it here decided that it was time to not support it anymore because they believed that it was a worse situation than possible, and that's the only way to explain it. Now let's go to the indexes, since that's what part one's all about. So let's look at the Dow Jones Industrial Average. As you can see, volume was lower, and that would be a good day if it was a down day, but today was actually a very bullish session as the Dow dipped lower and then closed near the high of day. I woke up late again, like around 9 o'clock, and I don't watch the market intraday. I always wait till after the day so I can describe to you these kind of actions, and so you can get a sense of what a real after hours, I guess is how you would say it, or in between market sessions trader investor actually goes about his business. But as you can see, it's a very bullish tail, and to actually close near where you started was a very bullish thing. So volume would have been huge today. I would have considered that like day one of a rally attempt. But you know what? It did not, and so the fact is that that's not what you had. Let's go to the New York Stock Exchange. Very bullish day today with the tail, of course, like a hammer. Bottom kind of looks like a hammer if you look at a hammer sideways. But the only problem is, look at volume each day. As it fell here, even though volume was lower, it picked up each day, meaning retail investors either shorted a lot or got out of it. And as you can see in September on its rise, volume gets lower every day. Even though it's higher than September, it's still a negative that the volume can't go the other way. Like this, instead of going this way, it goes this way, sadly. And that's why the stock is down from the October-November top. The New York Stock Exchange, I mean, I call it a stock again, 20%. So that's clearly bear market territory. So there's the New York Stock Exchange. It's not bullish. The 50-day moving average is above the price, and the 200-day moving average is above it. And with the way it looks now, it looks like it can last a little while longer. I would hope a bounce would come soon, but it doesn't look like it's going to happen. Let's look at the S&P 500. It should be the exact same way, and it is. The price is below the 50-day moving average, with the 50-day moving average below the 200-day moving average. Volume goes lower here, and on the fall off, volume rose, even though volume is higher than the last time. Just like I told you, the fact that it's going the other way is a bearish situation. Now let's go look at the NASDAQ and see what the NASDAQ looks like. The NASDAQ had another bullish session, but yesterday volume was only barely. It's what they call, what do they call these candles? I can't even remember right now. Engulfing. This is an engulfing candle pattern. Whenever you see it be bigger, it opens lower than the day before any of the price action and closes above the any of the highs of the previous day. So as you can see, it engulfs yesterday, and that would be super bullish if bullish was stronger, but sadly bullish was only a little larger. When I mean a little, I mean a little. Here it says like 22, I guess that's billion, and then here it says 22.8 billion, and this is 23.0. So it's not a really good engulfing pattern. And today, as you can see, it tries to rally a 3%, but look at volume. Volume is lower. So while it tries to rally the not the 3%, all you see is lower volume, so that's not good. The last index I want to look at is the small cap S&P 600 index, which is very important to me. To me, the volume probably was lower today, but it's another bullish session, and I love to see how it's holding above the 250-day moving average. And even though the 50 and 200-day moving average are in the opposite ways I like it, the fact that it can stay above the moving average and have all of these tails. Here's the first tail in early September, and then the 3 tails in a row, which either go below the 50-day moving average or stop right at the 50-day moving average, gives me hope that small caps might be trying to bottom. And another reason why I get a bullish feeling of that is because it's above the March and January low still, and as you can see, the relative strength line is much stronger than the S&P 600, which means that it's beating the S&P 500 by a lot. If you want to see a lagging stock, let's go look at what Fannie Mae looked like. See that relative strength line, how it goes all the way down to the low of the chart, and as you can see by the price, it agreed with it. And with the small cap S&P 600 staying above with the at relative strength moving that far up, I would consider that very bullish. So hopefully the small caps have bottomed, but I'm going to go ahead and wrap part 1 up here. This is Joshua Hayes at BigWaveTrading.com. I hope you enjoyed the presentation. Aloha.